Alright, let's talk Turkey. In one corner you have gold, the undisputed champion of value for thousands of years. It's heavy, it's shiny, you can hold it in your hand, kings have hoarded it, empires have been built on it, and your grandpa probably still thinks it's the only real money left on the planet. Gold has intrinsic value. It's used in everything from jewelry to high-tech electronics. It's the ultimate safe haven asset. When the world feels like it's spinning out of control, people run to gold because it's been a reliable store of wealth since the dawn of civilization. It's stable, it's physical, and it's not going anywhere. In the other corner you have the new kid on the block, the digital disruptor. Bitcoin. Booyah! This isn't your grandpa's asset. You can't touch it, you can't wear it, but it's making waves bigger than anyone could have imagined. Bitcoin is a digital currency, built on a revolutionary technology called the blockchain. Its value comes from its scarcity. There will only ever be 21 million Bitcoin, and its decentralized nature. No government, no central bank, no CEO can print more of it or shut it down. People who believe in Bitcoin see it as a bet against the traditional financial system, a hedge against the relentless printing of fiat currencies like the US dollar. So why are people trading them? It's all about making money, folks. These two assets represent fundamentally different views of the future. Trading gold is like betting on stability, on history, and on the enduring power of a physical asset. When you trade gold, you're often reacting to fears of inflation or geopolitical chaos. It's a slow and steady player. Trading Bitcoin, on the other hand, is a bet on technological innovation and a complete paradigm shift in finance. It's fast, it's volatile, and it's for traders who have the guts to ride the wild waves of a market that's still finding its footing. As of June 2025, we're in a fascinating moment where both gold, at over $3,300 an ounce, and Bitcoin, soaring past $100,000, are hitting record highs. This isn't normal. It tells you there's a ton of cash sloshing around the system, and people are hedging their bets in every way possible. They're buying the old guard and the new challenger simultaneously. This unique situation creates an incredible arena for traders, where you have to decide, are you backing the seasoned champion or the electrifying rookie? The showdown is on, and there's money to be made on both sides. Now you might think trading gold means buying a bunch of bars and renting a vault, or that trading Bitcoin means messing with complicated digital wallets and private keys. Wrong, that's for amateurs. The pros, the big-time players, they use something much smarter. Futures contracts. A futures contract is simple. It's a deal, an agreement to buy or sell an asset, like gold or Bitcoin, at a predetermined price on a specific date in the future. You're not buying the actual thing today, you're just locking in the price for a future transaction. It's like pre-ordering a video game to get it at today's price when it comes out in 3 months. So, why do this? Why not just own the gold or the Bitcoin? 3 reasons: leverage, hedging, and pure speculation. First, leverage is the magic word here. It means you only have to put down a small amount of money, called margin, to control a much larger position. For a CME micro Bitcoin contract, you might put down around $2,450 to control a position worth much more. This amplifies your potential profits and your losses, so be careful. It allows traders with less capital to get in the game and play for big league returns. You don't need millions to trade like a millionaire. Second, hedging is for the smart money. Let's say you're a gold miner, you know you'll have 1,000 ounces of gold to sell in 3 months, but you're worried the price will drop. You can sell a gold futures contract today to lock in the current high price. Now you're protected. The same goes for someone holding a lot of Bitcoin. If you're worried about a price crash, you can short Bitcoin futures, which is a bet that the price will go down. If the price does fall, the profit from your futures trade can offset the loss on the Bitcoin you actually own. It's a financial seatbelt. Finally, and this is where most of the action is, there's speculation. This is pure, unadulterated betting on which way the price will go. You don't care about owning gold or using Bitcoin. You just think the price is going up, you go long, or going down, you go short. Futures contracts are perfect for this because they are highly liquid, meaning it's easy to get in and out of trades quickly. And since you're not dealing with a physical asset, it's much more efficient. You can make your bet, take your profit, or your loss, and move on to the next opportunity without ever touching a gold bar or a digital wallet. Listen up, because this is where you separate the winners from the losers. You can't just look at a price chart, you have to understand the big economic forces that are pushing these assets around. This is macroeconomics, and it's not as scary as it sounds. Think of the Federal Reserve as the big boss of the economy. When the Fed prints money or lowers interest rates, it's like pouring gasoline on a fire. This easy money policy makes the US dollar weaker and pushes investors to look for assets that can hold their value. This is typically rocket fuel for both gold and Bitcoin. Inflation is the #1 enemy of your savings. It's the silent thief that makes the cash in your pocket worth less tomorrow than it is today. Historically, gold has been the go-to asset to protect against inflation. As the price of everything else goes up, the price of gold tends to rise too. Bitcoin is trying to become the new digital gold, a modern hedge against this same problem. Its fixed supply means central banks can't devalue it by printing more. So when you hear news about rising inflation, you should see flashing green lights for both gold and Bitcoin. Now let's talk about the opposite scenario. When the Federal Reserve gets worried about inflation getting out of control, it tightens its policy. This means raising interest rates and pulling money out of the system. Suddenly, holding boring old cash in a savings account becomes more attractive, because it's earning a higher interest rate. This makes riskier assets like stocks, and especially speculative assets like Bitcoin, look less appealing. Higher interest rates can be a headwind for gold too, but Bitcoin's price, which often trades like a high-growth tech stock, can get hit much harder during these times. Don't forget about global uncertainty. Wars, political instability, trade disputes, all of this chaos makes investors nervous. When people are scared, they seek safety. For centuries, that safety has meant gold. It's a physical asset that isn't tied to any single country's government or economy. Bitcoin is also starting to play a role here as a chaos hedge. It allows people to move wealth across borders when traditional banking systems are failing. So when you see scary headlines on the news, understand that fear itself is a powerful driver of both gold and Bitcoin prices. Okay, you understand the assets and the big picture. Now how do you actually trade? This is where technical analysis comes in. Don't let the fancy name fool you. It's just the art of reading price charts. Traders look for patterns, trends, and signals to predict where the price might go next. Is the price consistently making higher highs and higher lows? That's an uptrend, a signal to buy. Is it breaking below a key support level where it has bounced before? That could be a signal to sell. For both gold and Bitcoin, reading the charts helps you time your entries and exits instead of just guessing. But before you jump in, you must understand risk. I'm talking about leverage and margin. As I said, leverage lets you control a big position with a small amount of money. This is awesome when you're right, but it can wipe you out when you're wrong. A small price move against you can trigger a margin call where your broker demands you add more money to your account, or they will automatically close your position at a loss. Volatility is another huge risk. Bitcoin's price can swing 10% or more in a single day. That's a level of craziness that can turn a small mistake into a catastrophic loss. Gold is much less volatile, but you still need to respect the risk. The good news is, if you're trading futures on a regulated US exchange like the CME, you have protections. The Commodity Futures Trading Commission, or CFTC, oversees these markets. This isn't the Wild West of unregulated crypto exchanges. There are rules in place to ensure fair trading and, most importantly, a clearinghouse that guarantees your trade will be honored, even if the person on the other side goes bankrupt. This regulatory oversight provides a level of safety and confidence that you just don't get when trading on many offshore spot crypto platforms. It's a crucial safety net for serious traders. Here are my final tips for new traders. First, start small. Don't bet the farm. Use micro contracts like the CME's micro Bitcoin futures to learn the ropes without risking too much capital. Second, have a plan. Know your entry price, your target for taking profits, and most importantly, your stop loss price where you'll cut your losses and get out. Never trade without a stop loss. And finally, do your homework. Don't just follow a tip you saw online. Understand why you're making a trade. Whether you choose the ancient gleam of gold or the digital flash of Bitcoin, disciplined trading is the only path to victory. Now go out there and make some money.